Hey guys, how's it going? It's Andy. Today we're going to be talking about 3 Dividend Kings that I love going forward. These are 3 stocks that I plan to buy and hold forever. A couple of them are new additions to my portfolio going into the beginning of March. And the last one has already been a staple part of my portfolio as I've made the switch from growth stocks into dividend stocks. For those of you who don't know, dividend stocks are kind of arbitrarily grouped up into 2 categories of stocks. You have the dividend aristocrats, which mean that the dividend payout, not the yield, has been increasing for more than 25 years. And then there's the dividend kings, which have been increasing their dividend payout for more than 50 years. These are 3 stocks that I think, based off of their track record and being dividend kings, are stocks that I am going to buy and hold forever. We're looking for stability as the overall market has been incredibly volatile. These stocks have done better than the overall market in the past 10 years. They've had higher lows than the S&P 500 during the last recession. As the stock market continues to fall, we're looking for stocks that are not only going to outperform the S&P 500 overall, we're looking for ones that have higher lows and aren't going to drop as far when we have these drawdowns as the market continues to fall. So these are 3 stocks, and in any particular order, I can talk about some of the reasons why I really like them, and they are part of a couple different categories of stocks, so it's going to diversify my portfolio. Instead of in the past, I've been very heavy on renewable energy stocks. These are going to be 3 stocks that are pretty much recession proof. These are stocks that no matter how the market or how the economy is going to be going, these are products that people are going to continue to buy and use. That's why they've had such stable returns over the past 50 years with increasing their dividend yields. And that's why I'm excited to talk about them in today's video. The first stock on this list is going to be Proctor and Gamble, ticker symbol PG. It has a dividend yield of 2.18%, which is not super exciting, but they've been increasing their dividend payout for 66 years. And since 1995, their compound annual growth rate has been 11.5%. In the last recession, which was the financial crisis, I'm not going to talk about the pandemic stock crash because it was so short, it's really hard to see how the stock would have performed, as there was so much uncertainty about what was going on. So I'm going to go back to the financial crisis back in 2008. During that time, when the stock market, the S&P 500 specifically, recovered from its lows, Procter and Gamble was up 27% by the time that it had recovered. So this stock had a higher low during the stock market crash and was up 27% by the time the market recovered. When you look at Procter and Gamble, the 2.18% dividend yield isn't going to be super exciting. But when you look at its products, it makes sense why this is a stock that I would consider to be recession proof, because when you look at their main brands, they have stuff that are going to be a part of your household pretty much no matter what the economic situation is. You have Bounty paper towels, you have Charmin, you have Crest toothpaste, Dawn, Downy, Febreze, Gain, Gillette. Pretty much anything that you would use to stock your house for cleaning or like hygiene products are going to be part of Procter and Gamble. And this is not going to change as, inflation rises. This is not going to change if we have a stock market crash. These are products that people are going to use pretty much no matter what. And interestingly enough, from this Wikipedia article, Pampers is the largest brand of Procter and Gamble, which I would not have expected. When you look at their dividends, when I put up this chart, you can see that it's been steadily increasing. They have increased it for 66 years. So they have a dividend yield of 2.18%. And in the past 3 years, they've increased their dividend by 6.2%. Some people look for a dividend increase around 10%, but when you have a company that's been around for such a long time, between 5 and 10% is pretty okay with me, especially considering that it's been outperforming the overall stock market. When you look at some of the other things, payout ratio is very important because this shows the health of the overall dividend. The higher the payout ratio, which is determined as the dividend payout over the earnings per share, the more risky it is going to be to continue to pay out that dividend. So ideally, you're looking for a payout ratio that's below 65%. Some people change the goalpost depending on what they're looking for. But this is the history of Procter & Gamble for their payout ratio monthly since January of 2021. I've decided to go January 2021 because, as I mentioned, the pandemic was so hard to kind of judge stocks based off of value. So I wanted to look to see when the stock market was recovering and when there wasn't as much worry and uncertainty. So the latest data from February of 2022, their payout ratio is sitting around 58.5%, a very healthy range for it to be sitting at. So overall, Procter & Gamble is not a super sexy stock, but it has outperformed the S&P 500 since 1995. It had higher lows during the last recession, and it is a dividend king, increasing their dividend payout for the past 66 years. These are brands that are going to continue to do well no matter the economic situation that's going on at the time, and that's why it's going to be part of my dividend portfolio to buy and hold forever. This is a stock that I'm going to put onto my list that I buy every Tuesday morning, and I'm going to continue to add to it over time, and the dividend payout, while not incredible at 2.18%, is going to allow me to buy additional shares if the stock market continues to fall. Next, we're going to be going to a stock that's already part of my portfolio, which is going to be Abbvie, ticker symbol ABBV, which has a dividend yield of 4.5% with 50 years of increase in their dividend yield. When you look at the returns, it has only been a company since 2013. So you might be looking at it and go, how does that make sense? At the end of 2012, it was broken off from a company called Abbott Laboratories. And if you include the dividend yield from when it was part of Abbott, it has been increasing it for 50 years, making it a dividend king. But since it's broken off from Abbott in 2013, it has seen returns of 21.7%, which is very impressive. So Abbvie is going to be a healthcare specific company. Proctor and Gamble is a consumer discretionary and consumer staple products company. Abbvie is going to be more focused on the healthcare section of my portfolio. When you look at their products, their highest revenue source is coming from Humira, which is a rheumatoid arthritis product, making up, $19 billion from the revenue from 2019 and 2020. There have been some talks recently that there's a little bit of worry about what's going to happen with Abbvie in the future, because I didn't know this until recently. When products are patented from the FDA, it has around 20 years before you can spin off generic products of it. This is why you can get generic aspirin or ibuprofen. So Abbvie is in an interesting spot with Humira because it's their largest product. But from everything I've seen, their other products have been rapidly increasing over time, and they put a decent amount of money into research and development. So I'm not super worried about that right now. But Humira won't be able to be broken off into a generic product until 2023. So we still have 2 years of growth when it comes to those revenue sources. When you look at Abbvie, as I mentioned, it has incredible returns, the 21% since 2013 when it went public. But looking at their stats overall, you have a forward dividend yield of 3.92%, which is much higher than the average when it comes to dividend stocks. And the dividend yield is currently sitting at 4.37%. It is at the higher end of its 52-week range, which doesn't really worry me too much. This is not a company that I'm really worried about the overall value. When you're looking at Dividend King stocks, I don't really care the price. Obviously, it's going to be more attractive if the stock price has gone down significantly and I can buy it at a discount. But based off of the incredible returns over the past, 9 years, I'm not super worried about that. And the payout ratio, even though the stock price has gone up, this is on the lower end of its payout ratio at 37.36%. So even as the stock price has gone up significantly, their earnings per share has kept up with that pace, meaning that the dividend payout over earnings has decreased over time, and is currently sitting at a PE ratio of 34, which really doesn't mean that much. It's not incredibly overvalued. When you're looking at some of the value stocks, 34 is going to be kind of high, but I'm not worried about it in the slightest. So Abbvie, as I mentioned, is already part of my portfolio, and that 4.5% dividend yield is super attractive. Next, we're going to be talking about a stock that I think most people have heard of, Johnson & Johnson, ticker symbol JNJ, which since 1995 has seen returns of 11.3%, which is a little less than the other two stocks on this list, has a dividend yield of 2.6%, and during the last recession, it recovered 39% in the time that it took for the S&P 500 to recover. So Johnson & Johnson is another one of those companies, kind of like Proctor and Gamble, that is going to be a recession-proof stock. We have had some very interesting news come out with Johnson & Johnson recently. They announced that they're going to be splitting the company into 2 different publicly traded stocks. It's going to be split into consumer products and the pharmaceutical part of their business. So when you look at their business right now, around 50% of their overall revenue is going to be coming from the pharmaceutical part of their business. And 30% is coming from medical devices, and the rest is going to be the consumer products division. As of right now, I don't have a solid answer on which one I prefer. Right now, Johnson & Johnson is a part of my portfolio because of the incredible history that we've seen. Johnson & Johnson has been paying out their dividend for 61 years. And when you look at their growth for their dividend over the past 20 years, I think it's always better to look at a larger time frame, especially with the craziness that we've seen in the past 5, 10 years. In the short term, the last 3, 5, and 10 years, it has been decreasing. That is expected because as the stock price has risen significantly after the longest bull market in the history of the stock market, that's going to be expected. But 9.4% over the past 20 years is a very solid number to look at. And as I mentioned, the 61 years, very safe when I look at it overall. When you look at the numbers when it comes to Johnson & Johnson, it's sitting just below its midpoint for its 52-week range, currently sitting at $163. But when you look at the spread for the 52-week range, it's not super wide, going from only $151 up to $180, and it's currently sitting at $163. So that's a good thing when we're looking at stocks that are going to have lower volatility than the overall market, because that's one of the main benefits, in my opinion, to dividend stocks. They're not going to fall as far as the overall market. And with that payout ratio sitting at 40.7%, they could steadily increase their dividend over the next couple quarters, and there wouldn't be any worry about that in the slightest. As you can see, the payout ratio in the history has gone up to 590%. Obviously, that's not a sustainable range. That's probably during the pandemic if I had to look at it. So 40.7%, that is a super healthy dividend, and it makes sense why they've been able to steadily increase it over the past 61 years. So Johnson & Johnson is one of those stocks that it's going to steadily go up. It has not outperformed the overall market by a significant margin, being only up 11.3% compared to the around 10% of the S&P 500, but its history of increasing its dividend at 2.6% is nice. But I think the most attractive thing about Johnson & Johnson is that it was up 39% in the time that it took for the S&P 500 to recover from the last recession. As we're looking for good value to buy as the market falls, I think this is one of the most important things to take a look at. Not its returns over the past 20 years, because the stock market has just been chugging along for the past decade. I think we want to look to see how the stocks have done during times of trouble, because when we're looking at dividend stocks, those are when they're really going to shine. As growth stocks start taking off when the economy and inflation eventually falls, dividend stocks won't look as attractive, but as the stock market continues to fall, they're pretty attractive. So overall in this video, we talked about Proctor and Gamble, ticker symbol PG, talked about Abbvie, ticker symbol ABBV, and then we finished up the video talking about Johnson & Johnson. These are 3 dividend kings that I'm going to be adding to my portfolio at the end of February and going into March, and continue to buy and hold them forever. These are stocks that I think, with their track record, deserve to be in my portfolio and not have to worry about what I'm going to be doing with them in the future. Am I going to sell them off if things go poorly? Because they have the track record to show that they can weather the storm as the stock market and the overall economy suffers. These are 3 companies that have done incredibly well as the economy has fallen and recovered. These are stocks that I would consider to be recession proof, because you have Procter and Gamble with consumer staples, you have Abbvie with healthcare, and then you have Johnson & Johnson that has the pharmaceutical part of their business, but also the consumer products. So these are recession proof stocks, and I'm going to be buying them no matter what. And that's why they're going to be a part of my portfolio from now and going on forever. Thanks for watching this video. Let me know what dividend kings you'd like me to talk about in a future video. And if you made it this far, I really appreciate if you hit that like and subscribe button, as it would help my channel grow. I'm trying to reach 10,000 subscribers, and I need your help to do that. Thanks for watching. I appreciate all support, and I will see you in the next video.